All right, welcome back to another video. My name is Ian Major. I'm an entrepreneur, investor, and all-around raging capitalist. And in today's video, I'm going to go into this eternal debate between inflation and deflation. And this is a debate that's really been raging for arguably a number of years now, but especially in 2020. And there's pretty good reason for that. On the one hand, you have folks in the inflation camp saying, well, look at all the kind of money printing that's happening. Unprecedented levels of central banks around the world increasing base money in their various economies. And so that, you kind of intuitively folks think, okay, that naturally leads to inflation. In the deflation camp, you have, look at this kind of COVID shock, the second, third order effects of that in terms of potential insolvencies in, people, businesses, other entities. I mean, that really hasn't even started yet. And so that entire yarn ball of second, third order effects as a result of this shock, from COVID and really from the lockdowns, hasn't even kind of flowed through the system at all. You couple that with the long-term deflationary impacts of technology, as well as demographics. A lot of major nations in the world have demographics that are aging rapidly, and so all of these are kind of creating this deflationary cocktail that's going to be extremely difficult to escape. As a quick sidebar, for anyone who hasn't read The Price of Tomorrow by Jeff Booth, it's an excellent book that goes into why we actually should embrace deflation in this kind of technology-led world. But that is for another day and another age, it almost feels like, given where we are today. I'm in a new setup here, so I think I'm back home with family, enjoying the holiday times. So sorry if this is a little bit rough. But with that, let's jump in. And what I first want to do is highlight a couple of the very recent headlines we've seen. So we just today's December 3rd, Thursday, and just yesterday, you saw some of this news coming out around is inflation back in the US, right? And what was happening is, as you can see on this graph, it was really a story about the 10-year break-even inflation rate. And this is basically measuring expectations around inflation and where inflation is going to be. And this is somewhat significant in the sense that it's certainly ticked up a lot more since the massive spike and crash that we saw back in March, which you can see this big spike downwards. And this also is interesting in the context of some of what we've heard Jerome Powell say around, hey, we're no longer just targeting that 2% inflation rate. We're happy if it goes higher, such that over a longer period of time, we're averaging towards that 2%, right? So it's not necessarily a ceiling. It's an average that we want to achieve over a longer period of time. If you haven't watched my last video where we deep dove on the nature of inflation, be sure to go ahead and check it out. I'll put a link in the description down below, and it'll go into why, we really, again, shouldn't trust these numbers a whole lot anyway. They're complete bogus, but it tells you something when even a bogus measure that the government's putting out is creeping up, and so that is noteworthy and interesting. So that's sort of the backdrop. Now, where am I casting my bet? Well, let's first talk about why the Fed actually can't create inflation. Which is, I think, not a very well understood topic, especially with broader population, right? Because we all have this kind of mental image of money printer go burr, and that's sort of it, right? There's just kind of printing. We're adding digits in a digital ledger effectively is what is happening. But let's talk about why that actually doesn't necessitate inflation. And in this highly, almost grossly simplified diagram of quantitative easing in theory, what's basically happening is, the central bank, whether it's the ECB or, the Fed here in the US, is creating base money. And specifically, they're creating bank reserves. And so what they're doing is they're exchanging, or they're increasing bank reserves, which are liabilities to the Fed and assets to the commercial banking system. So think of, Morgan Stanley's of the world, right? These large primary dealer banks are buying treasuries from the federal government, right? And they're doing that as part of treasury auctions, which happen on a recurring basis. And so these large financial institutions, or primary dealer banks, as you'll hear them called, are essentially selling the treasuries, or mortgage-backed securities, to the central bank in exchange for the central bank debiting their account with more freshly printed, as it were, bank reserves. And so that mechanism, all that's done is it's increased the base money. But it doesn't necessarily mean that Joe and Jane in the real economy now have more dollars in their wallet to spend, right? And so what has to happen here is, and again, this diagram speaks about the theory that central bankers would have you believe, which is, that act of buying treasuries, and, the Fed can do that across the full, yield curve, wherever, long rates, short rates. And what that will do is drive interest rates down, right? Because there's this demand for, demand for bonds. Bonds are inversely proportional with interest rates. And so, the price of bonds going up means interest rates are going to go down. And that, in theory, leads to businesses and people borrowing more because interest rates are lower. And so, they borrow more, they spend more, and therefore the economy goes up. But what this sort of overly simplistic diagram fails to really articulate is there's this transfer mechanism that has to happen that takes that base money that's just been created and, actually transfer that into the real economy. And so that has to happen through the commercial banks currently. And so if banks aren't lending, and by the way, they're not, and people aren't really borrowing, we've seen savings rates across these last few months spike to kind of unprecedented, historical highs, then people aren't, there's not more money in the system flowing around. And that's what creates inflation. And so what the Fed really wants to create is money velocity. And as we can see here, we're at extraordinary lows in terms of money velocity. This goes back, as you can see, all the way to the 1960s. And what money velocity is measuring is basically how many times does a dollar go around in terms of the GDP for a certain time frame. So how many times is that dollar sort of exchanging hands in different transactions in the economy? And as you can see, as of Q3 2020, it's kind of popped up a little bit off of that floor, but it's still extraordinarily low. And so this is the key aha. The Fed can print base money all it wants, and it can increase bank reserves all it wants. There's no limit on that. But if there's no velocity, if banks aren't lending, if people aren't borrowing, that money is not making it into the real economy. And where it's going instead, don't think that there's absolutely no inflation, because there is, but where that money is going instead tends to be financial assets. And here we can see a really nice kind of walkthrough all the way from 2008 with the great financial crisis and the subsequent initiation of quantitative easing, number one. Number two, round three, you can see in 2018 it started to actually do quantitative tightening. So it started to actually reduce the size of its balance sheet. The market did not like that. Stocks reacted quite negatively. And so the Fed reversed course later in 2019. And then you can see this truly meteoric rise most recently in 2020. And so that's sort of what is happening. If that increased base money isn't getting into the real economy to actually create, sort of consumer price inflation as per what the government would define, it's going to go into financial assets, which is what we've seen. And so this is interesting, right? The Fed can't create inflation. It can only influence psychology and people's expectations for inflation, which we've seen arguably start to have some effect. So, taking a step back now, my answer to this argument and question of inflation versus deflation is inflation. So why is that my answer? And what are then the potential transfer mechanisms if the Fed printing bank reserves doesn't necessitate or automatically translate into inflation? Transfer mechanisms, you've seen the Fed and Treasury, at least in the US, collaborate more and more closely together. And you're going to see more of that. And that is so that the Fed can plan its sort of balance sheet acrobatics in accordance with the federal government spending money, is what that collaboration is doing. And so we're going to see more, stimulus checks. We can already see some movement there. With the presumed kind of incoming Biden administration, you're gonna definitely see more stimulus checks. This idea of UBI having been such a wild idea, a few months ago, really is shockingly catching on, in ways that we probably wouldn't have expected. Particularly when you combine UBI with, central bank digital wallets. I mean, just think about how you could now have the government directly injecting money into people's wallets. Now they can, influence not just base money creation, but also the actual velocity, which, as we discussed, is the real key to influencing that. There's also, different ways that the Fed can now, through these, special purpose vehicles, which are far outside its original charter, and so arguably illegal, but who's going to do anything about that? You're going to see more and more support for municipal bonds, local governments, and so if the Fed is essentially backstopping local governments by buying up municipal bonds, those local governments can in turn do the actual spending. You also have different kind of infrastructure spending efforts that we'll likely see. I mean, the Green New Deal, all this stuff. All of these are transfer mechanisms that can take quote unquote printed money or more base money and transfer that into the actual real economy. So another good question is, this debate has really good arguments on either side. And so, what level of conviction do I have in the inflation camp? Well, think of it this way. The federal government literally cannot afford to have deflation. And so they're going to do everything in their power to avoid that. Why can't they afford to have deflation? It's pretty simple. It's because they cannot afford positive real rates of return. So real rate of return, right? You take the nominal interest rate and then you subtract off inflation for the real rate of return. But if that inflation variable is deflation and is therefore negative, then your nominal rate minus a negative is a positive, right? And if that, deflation component is getting more negative, then that means you have rising real rates. And the government cannot afford this. And we see a great, as always, kind of summary of this from Luke Grumman, one of my favorite kind of macro voices. And so he's pointing out here, as you can see, COVID has basically left a gaping fiscal hole for the government. And so you now have interest payments on the debt plus the required pay-as-you-go components of entitlements at greater than 100% of tax receipts for 2020, right? And so think about that for a second. The government is now in a position where it has to print money just to pay the interest and mandatory pay-as-you-go components of entitlements, to sort of stay afloat. And so, essentially the government is insolvent. And so they are going to, not let deflation come in and increase real rates of return, which will make their debt burdens even harder, right? That's kind of the idea. Deflation would also mean a collapse of asset prices, whether it's real estate, whether it's the stock market. The other, key nugget from Luke here is stocks are currently now at 172% of GDP. And so what that means is that the stock market and sort of the gains within the stock market are now a key component of actual consumer spending. People's stocks go up, that makes them feel wealthy, that makes them feel more confident. And just mathematically, if you now look at it, given how big it's gotten, a collapse in stock prices would have a detrimental effect to overall consumer spending, which would have a detrimental effect to GDP, which would have a detrimental effect to debt as a percentage of GDP, which would again put upward pressure on interest rates for U.S. government debt. And so either of these paths yield something that the government cannot afford and will not accept. And so the only kind of release valve in this is to continue, printing the money. So my bet is that there's a far stronger incentive for the government to use the U.S. dollar as a release valve versus let deflation take hold and let the full house of cards collapse. No one's going to do that on their watch. They haven't done it, in the last 50 years, and they're certainly not going to do it now. So that leaves us with the all-important question of what should you do? Well, if you believe the deflation story, really the only answer there is the U.S. dollar. I mean, that's the only thing that's going to benefit in the short term if there is a deflationary spike. And there could be, right? I mean, we're going to get into 2021, depending on how stimulus plan plays out. There could easily be, another kind of deflationary spike similar to what we saw back in March. My bet is that would be, relatively short term. And again, the Fed and the government in concert together are going to step in and do everything they possibly can to counteract that. And so, if like myself and many others, you kind of believe the inflation narrative, Bitcoin is an absolute must. It's been a fiery sword that has, pierced through all the printing. If you look at, the price of Bitcoin plotted against the increase in M2 money supply, and it's been far more potent than other potential hedge assets like gold and precious metals. But have some gold as well. Gold and gold miners should do quite well and be well poised, but they're going to be less explosive than Bitcoin. And keep in mind, right, in this environment, stocks are probably going to continue to do okay, at least for a little while. And that seems counterintuitive when you see the real economy, still struggling. Unemployment's very high still, and you have, just really, really challenging conditions ahead. It's crazy to think that, we're at all-time highs for the stock market. But again, as per what we saw earlier in this video, you can see where that money is going. If not into the real economy, it's going into financial assets. And so what we're going to see is more of that. So I'm going to leave it there for today. What do you think? I would love to hear your thoughts. Make sure to comment down below. Give this a like and subscribe if you like this content. Let me know what you'd like to see in the future. And for now, I'll see you next time.